So I think the biggest differentiator is we're focused on the utility and the infrastructure sector. They are, if you want, long duration assets. They give us good visibility as to outcomes. And as a result, we have, I think, a good visibility looking forward in terms of the performance that we anticipate and the performance that we achieve. The process of urbanisation has driven up, if you want, the demand from increasing cities, and within those cities, the growth of the middle class is probably quicker than the city itself. And that middle class is looking to travel, either airports, looking to, if you want, use toll roads, looking for mobile and data support. And all of that means investment, and that investment is what we invest in. So the ideal company is listed. Over 96% of our portfolio is listed. It's a company that's up and running and is operational, so we don't like the risk of a greenfield site, planning permission, build and construct, and then see where the returns are. We prefer an asset that's already up and running, where we can properly assess the management team and their capability and the performance of the asset. I would note that a number of the assets are building out their portfolio, so maybe adding a terminal, extending a port, and therefore there are strong growth drivers. It isn't a static asset base that we're investing into. I think the other key feature of an attractive investment is one where a unit at the top line, so a passenger, will result in an additional passenger will result in rising revenue. The rising revenue will result in a rising EBITDA, and the rising EBITDA results in a rising earnings per share. And that obviously gives us the growth visibility going forward. So our concentration is good management, good asset, and then good utilization. So I'd characterize our investment portfolio as bottom up, and that means we're looking for, if you want, businesses that we can invest in. We're not investing in an economy as such. We're looking for the opportunity and the management team. So I think it's supportive in as much as we still have positive GDP, we still have, the growth drivers in place. Interestingly, I think some valuations have pulled back, and therefore they are attractive when we look at them as investments today. As an illustration, our top investment is International Container Terminal. They are a port operator based in the Philippines, expanding their portfolio. Interestingly, their unit, if you want, which is a container which goes through the port. The number of containers going through the port, if I go back to the year before, is 6.4%. Year to date, they're running at 6.5%. So that's showing me that they're benefiting from general GDP in the global economy. More interestingly, when I look at their revenues are up in double-digit numbers. And if I look at EBITDA and down to EPS, it's strong. And that's what you'd expect. You'd expect that fall down as their operational leverage, because of the number of containers going through, rises. So I think a key outcome of investing as we do is, because the assets are operational and up and running, they're generating cash flows, majority of them are paying a dividend, and obviously we're the beneficiaries of that. Our co-investors are, like us, looking for rising earnings and rising dividends, which is what we have enjoyed. So going forward, I am confident about our ability to pay dividends, and the board is committed to paying dividends. I would note we've moved to the UK, and we're now a investment trust listed on the primary market in London. And in our first year, our earnings covered our dividends.